now I'll move on to some sort of more specific scenarios that SAGE members have highlighted for us. So the first is an example of a two-director company. One director has already drawn a pension after serving in the armed forces, and the other director is already making contributions to her personal pension. So how is auto-enrolment relevant to them in that situation? Okay, so there are two directors in the company, and we can assume that they're workers for automatic enrolment. We don't really look at the fact that the armed services pension is being paid, because that's outside the remit of automatic enrolment. So his qualifying earnings or her qualifying earnings would need to be assessed for automatic enrolment, and if the eligibility criteria was met, potentially would need to be automatically enrolled into a pension scheme. Now, the other person, the other director who has a personal pension, it is possible to pay contributions into that personal pension, but the personal pension does need to be a qualifying pension, and it would need to make sure that the contributions were made. So at the moment it's 1% minimum from the employer and 1% from the employee, though the employer can pay all of that.
I think there's another thing to think about, because people are living a lot longer than they did historically. So when these pension schemes were first sort of envisaged many years ago, the life expectancy was going to be a lot shorter than it is today. And while some of these pension schemes will be index linked, even something like CPI and RPI doesn't really always reflect the costs an individual have when they retire. And perhaps, you know, living long means it's a good opportunity to really enjoy your retirement and have a little bit of extra spending money to do the things that you'd like to do. So just because someone is in a pension scheme, you know, it's not for the employer or even the policymakers to judge whether that pension scheme is enough for them in their retirement. The point is, if they're working, they're earning money, and that's an opportunity for them to further contribute towards the money that they're going to have in retirement, take an opportunity of the employer's contributions, take an opportunity of the tax efficiency, and have more money for their retirement. And that's really the whole policy intent behind this.
Another scenario put forward by a SAGE member is about exemption in relation to auto-enrolment. Now, as they understand it, a single director is exempt from having to operate auto-enrolment. So their question is, if they then take on an employee under a contract of employment, then employer duties only apply to the director if they have a contract of employment. Is this correct?
It's a relatively complex scenario. Let's talk about the exemption first of all. If a company has one employee, and that employee is also a director of that company, then that employee is exempt from the regulations, okay, for the work that they do for that company. But the company isn't necessarily exempt. If that was the only person who was a worker, then the company would be exempt. But there are people who are subject to automatic enrolment who are not employees, and even though they might consider themselves self-employed, if you have someone on a personal services contract, and by that we mean that they're a named individual, they have to perform the work, they can't freely substitute or delegate or subcontract the work to somebody else, then you need to check, the employer needs to make a reasonable judgment on whether that person is carrying out this work as part of their own business or not. Now, that's not necessarily completely straightforward, but there are a number of things that they should consider, which we've listed on our website. So I suggest that if anyone has these worker types, that they go and have a look. But broadly speaking, conceptually, I often describe this as, if a contractor looks, smells and feels like an employee, then it's quite likely that they would actually be considered a worker. And if they therefore are considered a worker, even though they're not an employee, we call them personal services workers, then these people are subject to automatic enrolment. So let's come back now to the scenario where you have got one employee, they're also a director, they're exempt, and they're the only person who works for the company. Therefore the company has no workers and therefore that employer has no duties. Okay? If they take a second person on, if that second person is an employee on an employment contract, then that nullifies the exemption. And both the new worker and the employee director now become subject to automatic enrolment. However, if the second worker is not an employee, they are a contractor, and they're deemed to be a worker, then the company now has responsibility, but only for that second person who's joined. The single employee, who's also a director, is still exempt, but the company now has responsibilities for the new worker. So that's how it operates.
So if it's multiple directors?
It depends what these directors are, because a director is just a job title. You can have executive directors who are employees. You could have an executive director who actually is really acting as a non-exec director but has additional responsibilities not covered under a contract of employment but covered by a contract. So really you've got to get under the hood, if you like, to understand what the real nature of the work's being carried out. I mean, broadly speaking, non-executive directors, if all they do is a sort of a non-executive type role where they're really getting paid sort of expenses for doing, 2 days a month, then they're likely to be considered office holders, and they're not really considered to be people who have contracts for work. But you need to look beyond the job title and actually understand, in reality, what are they? Are they office holder? Are they employee? Are they a contractor? And if so, are they a personal services worker?
Great, thank you. And another scenario for you, Rebecca. What happens with the contributions if someone turns 22 halfway through a pay period? Does it prorata the contribution? So,
yes, the contribution would be from the time that they turn 22 to the end of that pay reference period. What an employer may want to find out is whether they are able, or their software systems are able to make prorated contributions, and it may be that that isn't possible. And they may, in that scenario, choose to use postponement. So postponement means that you can postpone the assessment of that worker, and you might, for example, choose the beginning of the pay reference period so that you then don't have that problem.
But there have been some additional legislation that was laid back in November 13. And this legislation said that if the pension scheme rules were based on the Pension Act, in other words, they're a legal minimum pension scheme based on the legal minimum of qualifying earnings, then this additional regulation said you don't have to prorate. And on that topic, there may well be, depending on which pension scheme the employer is using, scheme rules that may explicitly say if you join in the middle of a period, you have to pay the pro rata amount. Or it might say if you join in the middle of a period, you don't have to pay anything. Or it might say if you join in the middle, you have to pay a full period's contribution. So that there's going to be different scheme rules depending on the pension scheme. And there may be some that are silent on the matter and don't say anything. So really the first thing to understand is whether the pension scheme requires a part contribution. The second one, as Rebecca said, is if so, and you want to avoid it, because it may be that the software that you're using that calculates contributions can't cope with a part contribution, and therefore the best way out of that is to use postponement.
For perhaps you, Rebecca, after an employee has been enrolled and their earnings fall, do I have to reassess them and take them off the pension, or offer them a non-qualifying scheme?
So once you've automatically enrolled somebody, they are in the scheme. And in spite of the fact that the next assessment period, their qualifying earnings may mean they would have been below the threshold, the point is that they're now in a scheme, so job done. But maybe the question is more about pension contributions. So it's possible that somebody who goes under that threshold, if an employer is using the banded earnings for pension contributions, so they're using qualifying earnings as a way of determining pension contributions, it may be that no pension contribution comes out of their pay packet, but nevertheless they remain in the scheme, and if in the following pay reference period their earnings go up, then a pension contribution would be taken, but you leave them in.
Yes, so employers shouldn't be removing people from pension schemes. Once they're in, they are then an active member of a qualifying scheme, at least for as long as the scheme remains qualifying for them, or they choose to cease membership or opt out. And if they're an active member of a qualifying scheme, you've done your duty as the employer. You can almost ignore them as far as automatic enrolment is concerned, because the job is done.
Do you have any sort of advice around managing opt-outs for accountants?
Well, the first thing to make sure is that the statutory opt-out, now what we're talking about with the statutory opt-out is either someone who's been automatically enrolled, or they've said, I would like to opt in, they can still change their mind. They both get an opt-out period. It's 1 calendar month. And it doesn't start until 2 things have occurred. The first one is they've been enrolled in the scheme. They've achieved active membership, so you can't opt out until you're in. And the second one is they've been issued a letter to tell them they've been automatically enrolled. So once those 2 things have happened, your 1-month calendar window starts, and then a statutory opt-out, the process has to be handled by a pension scheme provider. If that employee or worker goes to their HR department or the person within the small employer who does these things and says, I want to opt out, can I have an opt-out form please? That person must say, no, we'll tell you how to do it, but you need to go and get the form from the pension scheme provider. So that pension scheme provider is the one that should be dealing with the worker in the opt-out process until they've signed on the dotted line and completed the process. And at that point, they can give the form to their employer and say, I've opted out, because they'll need to stop the deductions being taken from their payroll and to arrange for a refund. However, that 1-month window, if people don't opt out then, that doesn't mean they can't cease membership of the scheme afterwards. It just means that if you did opt out in your opt-out window, your memberships are completely unwound and you will get a refund as if you'd never joined. And by the way, if you're in fixed or enhanced protection, if you've reached the lifetime limits, the pension contributions and you're part of those HMRC schemes, that's what you'll need to be doing to make sure that you then don't make a pension contribution and don't breach your HMRC rules. But coming back to people who do miss the window, they can still leave the scheme. Whether they get a refund or not will be determined by the scheme rules. Nest doesn't give refunds. Other schemes might give them the contribution value. Others might say it's the fund value that you've accumulated that you get. Yeah. In that case, however, they could go to the employer. So it's only the statutory opt-out process where it's got to be the pension scheme provider. And that also means, by the way, that if you've got any other third party like an accountant, that accountant has been commissioned by the employer and therefore is acting as an agent of the employer, they should also not be giving out opt-out forms. They would need to have a contract with the pension scheme provider to act on their behalf in order to actually be involved in the opt-out process at the beginning. So I would think really that in practice that means that the accountant should also ensure that the person knows how to opt out, but they need to go to the pension scheme provider.
Another question for you, Rebecca. So we deal with a lot of small businesses where the only employee is on the payroll is the owner. We understand that these are not workers for automatic enrolment purposes, but is there a reporting process for this so that they don't get chased by the pensions regulator for failure to register?
It's a good question to ask, and Neil's also covered that they would be exempt from automatic enrolment duties, but it is possible that the pension regulator would send them a letter if they failed to finish their declaration of compliance or register within 5 months of the staging date. So if they were to ring us up and tell us, actually, we are exempt and the reason, then we can make a note of that so they don't get that letter.
Right. So quite straightforward.
Yeah, it should be.
Great. And one more question about the tourism industry. So some of their clients work in tourism. They work variable hours and a lot of the work is very seasonal. So for some employees, taking earnings as an annual figure, they're dramatically below the thresholds. But in a single week or month, they might exceed the limit. Is it possible to refer the calculation once the employee becomes entitled for 3 months and essentially continue this process each time they become entitled to counter the effect of fluctuating earnings?
Well, the short answer is no. The short answer is the annual figure is just an estimate. It's just, you know, if £10,000 per annum is sort of the benchmark, you don't have to earn 10,000 because it's not measured on an annual basis. It is measured on a weekly, if you're weekly paid, or monthly, if you're monthly paid, etc. So what they will have to do is monitor their earnings every pay cycle, and if they go above that weekly or monthly or fortnightly threshold, they've triggered automatic enrolment. However, employers have a choice. They have the option under the legislation of applying postponement. So they could postpone for up to 3 months, and if that person who's been postponed 3 months later in the pay cycle that they're being paid at the end of the 3-month period, if they are not above the threshold, then they can go back into the pool to be monitored, so you don't have to automatically enrol them. But if they happen to have had another spike in their earnings and they've also gone above the weekly or monthly threshold at the end of the 3-month period, then you have to automatically enrol them. You cannot use postponement again, otherwise you could do that indefinitely and there'd be absolutely no point in doing any of this because you wouldn't have to automatically enrol anybody. So you don't do a 3-monthly calculation, you don't look at what they've earned in the 3-month period, you simply look at the earnings in the pay period in which the last day of postponement falls. And if you're above the appropriate threshold for that week or month, you will have triggered automatic enrolment, and there's no further defence, if you like, you have to enrol.
That's great advice, thank you very much. And just to wrap up now, thank you very much Neil and Rebecca from the Pensions Regulator. It's been very insightful and valuable advice to get from you both. Thank you
very much.
Our pleasure.
Thank you.